Good afternoon, everyone. Myself, Archana Kaushik, Assistant Professor in the Department of Commerce of IIMT College of Management, Greater Noida. The topic of today's lecture is cost of capital, which is a very important topic in the field of finance, especially in financial management. Learning objectives of this particular lecture are definition of cost of capital, importance of cost of capital, components of cost of capital, cost computation of different sources of finance, concept of weighted average cost of capital, determination of proportion of or weights for WACC, computation of WACC, factors affecting cost of capital, limitations of cost of capital, real world applications, and conclusion. Definition of cost of capital. The cost of capital is the required rate of return that a company must earn on its investment to satisfy its investors and creditors. It reflects the opportunity cost of using capital in a specific project or investments compared to alternative investment opportunities with similar risks. Helping in importance of cost of capital, we'll start helps in making capital budgeting decisions. Companies use the cost of capital to determine which investment projects are viable and will create value for shareholders. It guides in financing decisions. Companies used to use the cost of capital to decide the optimum capital structure, that is, the right mix of debt and equity to minimize the overall cost of funds. To evaluate the overall company's performance, companies compare their returns on investments with the cost of capital to assess whether they are creating shareholder value or not. Assist in setting financial goals. Cost of capital serves as a benchmark to set financial performance targets for different business units. Components of cost of capital. The cost of capital, which is the required rate of return that a company must pay to its investor and creditors for using their funds to finance its operations and investments. When we talk about cost of capital, we always mean it is basically the weighted average cost of capital. That means the capital which comprises of different components or sources of finance we'll take the weighted average of the cost of all the sources of finance. So first of all, we'll take into consideration what are the main components of cost of capital. It includes cost of debt, cost of term loan, cost of equity, cost of retained earning, cost of preferred stock. First of all, we'll do with cost of debt. It is represented as capital K and small d. The cost of debt represents the interest expenditure a company pays on its debt financing. It is the cost associated with borrowing funds from creditors such as bank, bondholders, and other lenders. It is typically lower than the cost of equity due to tax deductibility of interest payments. Cost of loan. It is the effective interest rate that a company pays on a borrowed sum from a lender. It represents the interest expenditure associated with servicing the loan. Both the cost of debts and the cost of loans basically are the tax deductible expenditures. Always company gets tax shield on both the costs. Cost of equity. This is the cost of most riskiest source of finance, equity share capital. The cost of equity is the return required by shareholders for investing in the company's stock. It represents the cost of using equity financing, which involves paying dividends and potentially experiencing capital gains. It reflects the risk associated with investing in the company's share. Risk is involved in equity share because the equity shareholders are the real owners of the company. Moreover, equity shares are irredeemable in nature. Whatever company earns in the form of profit belongs to equity shareholders, but the distribution of dividend to the equity shareholders is the discretion which is in the hands of company whether company issue dividends or not. Cost of retained earnings. Retained earnings represents basically the portion of profits that a company reinvests rather than distributing as dividends. The cost of retained earnings reflects the opportunity cost of not distributing those earnings to shareholders as dividends because ultimately the retained earnings are basically the profits of equity shareholders only. And if the company is not distributing these profits as dividend to these shareholders, then the cost of retained earnings is basically the opportunity cost. Next is cost of preferred stocks. The cost of preferred stock is the rate of return required by holders of preferred shares. Preferred shareholders receive fixed dividends before common shareholders, making it similar to a combination of debt and equity. Preference shares are basically called as hybrid security. Why they are called as hybrid security? Because they combine the feature of both debentures and equity shareholders. Just like debenture holders, their income in the form of dividend, the rate is fixed just like debentures. While and the feature of equity is like the company in case of profits only will distribute dividends. In case of loss, company is not liable to pay dividends to the preference shareholder. It's an important component if the company has issued preferred shares. After considering cost components of cost of capital, now we are going to do cost computation of different sources of finance. Number one is calculation of cost of term loan, represented as KT. The calculation of the cost of debt is relatively straightforward. It is usually based on the interest rate the company pays on its term loan. Formula would be annual interest expense upon total term loan into 100, incorporating tax effect into cost of term loan. If we add tax effect in the cost of term loan, we will get post-tax cost of term loan. I have already discussed that cost of term loan is basically a tax deductible expenditure and we will get tax shield on the cost of term loan. So if we deduct cost of term loan, if we deduct in 1 minus tax rate from the cost of term loan, we will get after tax cost of term loan. Next is we'll consider an example. Let us consider a company with an annual interest expenditure of $50,000 on its term loan and an effective tax rate of 30%. The cost of term loan would be $50,000 upon total term loan into 100. And if we suppose term loan to be 10 lakh dollar, then cost of term loan would be 50,000 upon 10 lakh into 100. That equals to 5%. But this is the pre-tax cost of loan. If we want to calculate after tax cost of term loan, which is in actuality, so we will have to multiply this 5% with 1 minus 0.30 and we will get 3.5% as the after tax cost of term loan. Second is cost of equity. Cost of equity can be computed with the help of two most common methods. Number one, dividend discount model, and number two, capital asset pricing model. Let's explore each method along with their formulas and examples. First of all, dividend discount model. The dividend discount model estimates the cost of equity based on the present value of expected future dividends. The formula would be dividend per share upon current stock price plus growth rate of dividends. For example, suppose a company pays an annual dividend of $2 per share and the current stock price is $50 per share. The dividends are expected to grow at a rate of 5% per year. With the help of this information, we have to calculate the cost of equity with the help of DDM approach. As per the formula is dividend per share upon stock price plus growth rate of dividend. So we will apply 0.05 $2 upon $50 plus 0.05, which comes out to be 0.04 plus 0.05, that is 9%. Next is cost of equity computation using capital asset pricing model, also called as CAPM model. The cost of capital asset pricing model, the capital asset pricing model basically estimates the cost of equity based on the risk-free rate, market risk premium, and the company's beta, which is a measure of systematic risk. Company's beta basically measures the sensitivity of the stock. It measures the change in return of stock price over the change in the market returns. Formula would be risk-free rate plus beta into market risk premium. And market risk premium would be RM minus RF. RM means market return, RF means risk-free return. Excess of market return over risk-free rate would be the market risk premium. Let's take an example. Suppose the risk-free rate, that is RF, is 3%, market risk premium is 7%, and company's beta is 1.2. The cost of equity as per CAPM model would be zero point zero 0.03 plus 1.2 into zero point zero 0.07, that is 11.4%. Each method provides a different perspective on the cost of equity. And the choice of method depends on the availability of data, the company's dividend policy, and the investor's risk preferences. Companies often use a combination of these methods to arrive at a more robust estimate of their cost of equity. Next is the cost of debenture, also known as capital K and small d. This cost of debenture, also known as cost of debt, can be calculated using yield to maturity approach, which takes into account the present value of all the future cash flows associated with the debentures, including both interest payments and the final repayment of the principal. The formula to calculate cost of debenture using YTM approach with the tax effect is as follows. Formula is P0 is equals to I in bracket 1 minus T multiplied by PVIFA YTM comma N plus RV into PVIF YTM comma N. We always apply PVIFA, that is present value interest factor annuity, for the annuities, whereas PVIF in case of single payment. So as we all know, interest payments are basically the yearly payments. It's basically an annuity, and hence we will have to apply PVIFA factor. On the other hand, RV is the redemption value, which is applicable only at the end of the maturity. Hence, we will have to apply PVIF. For example, suppose a company issues debentures with a face value of $1,000 each, a coupon rate of 8%, a maturity period of 5 years, and a current market price of $950. The corporate tax rate is 30%. Solution would be the interest amount would be 1000 into zero point zero 0.08, that is 80. After tax interest would be 56, that is 80 into 0.70. If we apply formula, then we will have 950, that is issue price, equals to 56, that is interest after tax, PVIFA KD, 5, KD is unknown, we have to calculate it, plus 1000, which is the redemption value, multiplied by PVIF KD, 5. We will have to apply trial and error approach so as to calculate KD, and that particular rate which equates both the sides will be the cost of debenture. However, it is a time-taking concept, time-taking approach, hence we can always use approximate formula to calculate KD. The formula is KD is equals to interest after tax plus average of difference of redemption value and issue price, whole upon 60% of redemption value and 40% of issue price. In our example, it is 80 into 1 minus 0.3 plus 1000 minus 950 upon F, whole upon 60% of 1000 plus 40% of 950, which comes out to be 56 plus 10 upon 980 into 100, that is 6.73%. Next is cost of preference capital. The cost of preference capital is also known as cost of preferred stock. It is a discount rate which equates the present value of cash inflows in the form of preference dividends and redemption value occurring at different points of time in future with the present value of cash outflows in the form of investments made at present. The formula for calculating cost of preference share using present value approach is as follows. It is just like the formula of calculating cost of debenture with a simple difference of we are ignoring interest after tax. Here, preference dividend do not provide tax shield, hence we only calculate preference dividend into PVIFA, that is KP, N, plus RF into PVIF KP, N. For example, let's consider a company that issued preference shares with a face value of $100 each, redeemable after 5 years. The dividend rate on preference share is 6% and current market price of one preference share is $110. Solution in the solution we have preference dividend, which is always applicable as rate on face value. That is 6% is applicable on rupees 100, rather $100, which equals to $6. And formula for calculating KP is the P0 is equals to preference dividend into PVIFA KP comma n plus RV into PVIF KP comma n. 110 is equals to 6 into PVIFA KP comma 5 plus 100 into PVIF KP comma 5. KP can be calculated using trial and error approach method, which turns out to be 3.85. We can also use approximate formula to calculate KP. KP is equals to preference dividend plus RV minus P0 upon N whole upon 0.60 RV plus 0.40 into issue price. It comes out to be 6 plus 100 minus 110 upon 5 whole upon 60% of 100 plus 40% of 110, that is 4 upon 104 into 100, 3.85 per annum. Now the concept of weighted average cost of capital. The weighted average cost of capital is the weighted cost of all the sources of finance. Whenever we talk about cost of capital, it is basically the weighted average of cost of different components of cost. It reflects the cost of raising funds from all sources, considering the relative weights of each components in the company's capital structure. WACC is commonly used as a discount rate to evaluate investment projects that are expected to generate returns equal to or greater than company's cost of capital. Each component of capital reflects risk and return associated with different sources of financing. The relative weights of these components in the company's capital structure influence the overall cost of capital. There are two types of weights associated with capital structure of the firm: book value weight and market value weight. Appropriate weights are the target capital weights stated in market value terms. The primary reason for using the target capital structure is that the current structure may not reflect the capital structure expected in future. Market values are superior to book values because, in order to justify its valuation, the firm must earn competitive returns for shareholders and debt holders on the current market value of their investments. We have the formula of WACC just like weightage of equity into cost of equity plus weightage of return earning into cost of return earning, weightage of preference dividend into weightage of debt into cost of debt after tax, weightage of term loan into cost of term loan after tax, plus weightage of preference shares into cost of preference shares. Let's take an example. Suppose company XYZ has following information. Market value of equity, that is E, is $7 million. Market value of preference capital, that is P, $5 million. Market value of debt, that is D, $5 million. Cost of equity, that is KE, is 15%, which is the highest among all the sources of finance. The cost of preference capital is KP, 12%. Cost of debt, KD, is 10%. And tax rate applicable is 30%. First of all, we calculate the value of firm. Value of firm is the sum total of equity plus debt plus preference capital. 7 plus 5 plus 5, that is 17 million. After calculating the value of firm, we will apply the formula of WACC, in which we will have weightage of equity into cost of equity, weightage of debt into cost of debt after tax, weightage of preference capital into cost of preference capital. In our formula, in our case, 7 million upon 17 into 15 cost of equity, 5 upon 17 into 12% cost of preference shares, 5 upon 17 into 10% into 1 minus 0.3 cost of debt. Ultimately, we'll get WACC as 6.177 plus 3.53 plus 2.06, in which 6.17 is the weightage of equity cost, 3.53 is the weightage of preference cost, and 2.06 is the weightage of debt cost. Ultimately, WACC would become 11.767. Next is factors affecting cost of capital. Whenever we are considering or computing cost of capital, we should always consider internal and external factors which can change over time, which are influencing the computation of cost of capital. Number one, interest rates. Prevailing interest rates in the economy have a significant impact on the cost of debt capital. When interest rates rise, the cost of debt increases, making borrowing more expensive for the company. Market conditions. In times of economic instability or recession, investors may demand higher returns, leading to an increase in the cost of equity. During periods of economic growth and stability, the cost of equity may be lower as investors are more willing to accept lower returns. Companies' creditworthiness. A higher credit rating can lead to lower interest rates on debt, reducing the cost of capital and vice versa. Capital structure. No doubt, the mix of debt and equity in the capital structure would obviously affect the cost of capital of the firm. The higher proportion of debt in the capital structure typically results in the lower weighted cost of capital because of tax deductibility nature of interest payment. Interest payments always provide tax shield. As a result, the more influence of interest, more inclination of interest payments, interest cost in the cost of capital would result in the decrease in cost of capital. Conversely, the higher proportion of equity financing can lead to higher WACC. Next factor is industry risk. Companies operating in highly volatile or risky industries may have a higher cost of equity because investors demand greater returns to compensate for the additional risk. Regulatory environment. Changes in tax rates, for instance, can affect the after tax cost of debt and equity. Company size and growth prospects. Smaller companies and those with limited growth prospects may experience higher cost of equity because investors perceive them as riskier. Larger, more established companies, on the other hand, may have lower cost of equity due to their stability and growth potential. Market risk premium. The market risk premium, as per the CAPM model, basically affect the cost of equity. Higher we get market risk premium, more would be the cost of equity and vice versa. Investors' expectations. Investors' sentiment and expectations about a company's future performance play a vital role in determining the cost of equity. Positive news, strong performance can lead to lower cost of equity, while negative news or poor performance can increase it. Currency and inflation risk. If a company operates in multiple countries or faces significant currency and inflation risk, these factors can affect the cost of capital. Higher inflation or currency risk can increase the cost of capital due to uncertainty it introduces. So, after considering factors affecting cost of capital, we can conclude that it is essential for companies to continually assess these factors and adjust their cost of capital calculations accordingly. A thorough understanding of these factors helps businesses make more accurate financial decisions, including project evaluation, capital budgeting, and financing choices. No tool will be left without its limitation. Cost of capital is also a tool in financial management, which also affected by its limitations. Number one, it assumes constant capital structure, which is in the real world doesn't hold good. The cost of capital assumes constant capital structure, which may not reflect real world financing decisions. Number two, it ignores project risk. It assumes all projects have same risk, which may not be accurate for different investments. Real world applications. The cost of capital is applicable in real world conditions. First of all, valuation. It is used to determine the value of company or its equity. The value of company or its equity can be determined with the help of capitalizing the equity or capitalizing the profits of the firm with the help of cost of capital. Mergers and acquisitions. WSCC is used to assess the financial feasibility of a merger or acquisition. Capital budgeting. Companies use the cost of capital as a hurdle rate to decide whether to undertake an investment project or not. Whenever we are making investments in big projects, we always compare cost of capital with the required with the internal rate of return here with the expected returns from the project. If the returns which we are expecting from the project is higher than the cost of capital, then only we will approve, then only we will finalize that particular project. So, in this particular lecture, we have discussed what is cost of capital, its importance, factors affecting cost of capital, limitations, real world applications, components of cost of capital, their calculation, and afterwards WSEC, how these components compute in the helps in the computation of WSEC. So, in conclusion, the cost of capital is a fundamental concept in finance, and understanding it is crucial for making informed investment and financing decisions. It serves as a financial benchmark for evaluating the profitability and attractiveness of different investment opportunities. Thank you.